Hello students, and welcome to this lecture on borrow cost. And in this lecture we will specifically be studying general loans in terms of IAS 23. As always, I like to start with a quote of inspiration, and this is a quote by one of my favorite musicians of all time, Alicia Keys. She said, "You already are everything you have always dreamt of. You are just in the process of realizing it." And I think this is such a wonderful quote because it reminds us that everything we need is already inside of ourselves, and we don't need to seek for validation outside of ourselves. We should just keep working hard so that we can become the best versions of ourselves. So this is a wonderful quote. In the previous lecture, we discussed specific loans. And in this lecture, we will now turn our attention to general loans. So what are general loans? General loans are general fundings that a business or an individual even is able to obtain. And a good example would be bank overdrafts. If we think about a general loan, it is funding that an institution will provide to the business without asking any questions. And this is contrary to, for example, specific loans. Because for a specific loan, the institution provides the loan or the money, and you have to repay it in accordance with their agreement, but they expect of you to do something specifically with that money, like constructing a building or a plant. Whereas with general loans, the institution will give you the money and they don't ask questions as to how you're going to spend it. So you can use it to buy assets, but you can also use it to pay for your business expenses. So typically this is not a good idea to make a loan to pay your expenses, but it can be done because the institution doesn't ask any of these questions. If we think about a general loan, it is normally called a business loan or a general business loan. For individuals, a general loan is normally called a personal loan, whereas a specific loan for individuals can, for example, be a home loan or motor vehicle financing, where you have to use that money to buy a home or to buy a car. So this is the contradiction between general loans and specific loans. Something else that's also different with general loans is the rate that we use in our calculations. In specific loans, we are told that we need to use the effective rate. So the market rate or / effective rate is given to us in a question, or we have to use our financial calculators to calculate it. For general loans, we do not look at effective rates per se because we have to calculate what they call an average rate. So an average rate, I am going to demonstrate to you how it is calculated, but it takes into account all the different types of funding that are available, and then all the types of funding are basically thrown together in a pool to calculate an average interest rate that arises from it. In order to answer a general loan question, I always prescribe that 3 steps should be followed. And this might seem a bit abstract to you because you have not looked at these questions already, but these are the 3 steps that I think you should follow, because if you do it in a specific sequence, you will be able to successfully complete your answer. So step 1, you need to calculate your weighted average percentage. So I'm going to explain during this lecture what this entails. Then for step 2, you need to use that average percentage and calculate your weighted average interest in rand. And then in step 3, you have to go and calculate your actual interest. So normally students don't have a problem with actual interest because actual interest is just the interest that you've calculated even from doing accounting at school. It's just the loan times the percentage that goes with that loan times the months in the year. Right, I always say that accounting is difficult to explain in words, so it is better to have an example when one explains accounting. And I've created this example which says, suppose that entity C has the following general borrowings available. Right? So they tell you that the interest payments are done as interest is incurred. So this is a very important sentence because it means we need to pay interest at an ongoing rate in order to make sure that the loan agreement stays in place. Repayments of the loan will only start on 1 January 2023. So the capital we're not repaying, but the interest needs to be paid as we go. They said that there are 3 types of funding that the business has available. So the first type of funding is one is on 1 January 2021, which is our bank overdraft. Then we have a 12% there, and the maximum that's available for that loan is 1 million. Then on 1 April 2021, the business issues some debentures, and they carry a percentage of 15%, and a maximum of 5 million rand. And then on 1 February 2022, the business is also able to obtain a general loan at an interest rate of 14% to a maximum of 1.5 million. In the additional information, they tell us that the year ends 31st December and that the company is in the process of constructing a qualifying asset that is an intangible asset. The asset qualified for borrow cost on 1 February and it is ready for use on 31st of March 2022. So that would be our capitalization period. 1 February 2021 to 31st of March 2022. Intangible assets are written off on a straight line basis at 2% or 20% per annum, and then the intangible assets are carried on your cost model. Right, then they've also given you some progress payments. So progress payments are very important in calculating your average interest. So what is a progress payment? A progress payment is a payment that the business makes to the contractor that assists it with the construction. So let's say you're constructing a building, right? You do not want to give a contractor 10 million rand on the first day because they will just run away with the money. So typically what happens is that you set certain progress points in a contract and you say, on the day that they start, you give them 500,000 rand, for example. Then they have to finish the foundation of the building. Then you give them another 2 million. Then they have to put up the walls and they have to build as high as the windows will go, right? And then you give them another 2 million. So you put up certain progress points, and once they reach those progress points, then you will be able to justify paying them an X amount, and they will be able to collect the money and have some kind of right to say that we've earned this amount. So that's progress payments, and progress payments are very important because, as you will see in the calculations, we are going to use them to calculate your average interest in Rand. So let's start with step 1. Let's consider this example of entity C and then start with step 1. So the first step is to go and calculate your average interest rate, right? So that's the first step that I indicated here on the slide previously. What should be taken into account is that an average rate can only be calculated when there is more than one type of funding, right? So if you think about, for example, having students in your class, if I only have one student in my class, I can't calculate an average mark for a test because there's only this one. But if you have 10, 20, 50 students in your class, then you can calculate an average. If we look at the funding that is available, you will find that between 1 January and 1 April, we only have a bank overdraft. That's only one type of funding is available in 2021. And because of this, the average rate should be the rate of that type of funding that's available. And for this reason, I said between 1 January and 31st March, that's basically one day before. We don't account for one day in accounting, so potato, potato. But that is a 12% that the average rate should be in that period, 1 January to 31st of March, because we only have one type of funding. On 1 April, when there's a second type of funding, that's when an average rate can arise. So I always prescribe that we use this layout to calculate your average rate, where you take your loan type, and then the loan amount of that loan type needs to be adjusted proportionally to the remaining months in the year. If we look at the bank overdraft, we already had the bank overdraft on 1 January and it was worth 1 million rand. So we had it for the entire year. So proportionally adjusted, we would have said 1 million times 12 out of 12, which leaves us with 1 million. The debentures, however, are slightly different because they are issued on 1 April 2021 and they're worth 5 million rand. So now we need to go and proportion the 5 million rand in proportion to the remaining months in that year. So it's going to be April, May, June, July, August, September, October, November, and December, because they tell us the year end is 31st December, right? And that leaves us with 9 months. So we take the 5 million and we adjust it for 9 months, 9 over 12, which gives us 3750,000. The interest rates that I filled out in this column was given to you, and then it is your task to go and calculate the average rate. So the average rate, for the average rate, we use the proportional loan as a weighing factor, and we times it by the interest rate to get to the average rate. So in other words, for the bank overdraft, we will take the 1 million and the sum of all the funding that's available. So this 4,750,000 is the 1 million plus the 3,750,000. And that gives us 4,750,000. To calculate an average rate, it's the 1 million divided by the 4,750,000 times 12%, and that gives us 2.53%. So that is the average rate for the bank overdraft. For the debentures, we're going to take the 3,750,000 divided by the 4,750,000 times 15%, and that gives us an average of 11.84%. To get to our total average rate, we're going to add together the 2.53, 11.84, and that gives us 14.37, right? So that is the average rate where you basically use your weighing, you use your proportional loan as a weighing factor, and you times it by the interest rate in order to get to your average rate. Step 2 said that we have to go and calculate the weighted average interest in rand. So now we are busy covering this step 2, weighted average interest in rand. And now I again prescribe to use a block that looks like this. I like to do my calculations in a way that is very orderly. You can also refer to the summaries that I have posted to Vutela and go and look at that. So I put an empty template on these summaries that you can use to do your calculations. And for a template, I always draw up a date interval, an opening expense, a progress payment, a total expense, an interest calculation at the average rate, and then a closing expense. And I will explain how to use this block. But this is a very sequenced and orderly way of doing your calculations. And normally students don't struggle a lot with the calculations. However, they always ask me, but how do I know I have to use these date intervals? Like, how do I know I need to say January to February, February to April? How do I know this? So in order to do this, I always say that you should use a timeline or draw up a timeline. So this might seem like something that is going to take up a bit of your time, especially in a test. However, it is a good idea to spend an extra 5 to 7 minutes drawing up your timeline, and then you know for sure that your calculations will make sense as you progress. If you have to guess the date intervals and you make a mistake, then you will most probably mess up your interest calculations. If I look at this question, I've set up a timeline for us that we can use in order to answer this type of question. And what I've done is, on the timeline, I've indicated for you all the different time intervals that you need to go and look for on your timeline. So what do I draw on my timeline? What dates do I look for? You look for dates on which you receive loans, and you look for progress payment dates, and you also indicate year ends. So those are the three things that you need to indicate on your timeline. So you would see what I've now done is I started by saying on 1 January 2021, that should be a 2, excuse my terrible handwriting, 2021, I get my first bank overdraft funding, right? Then on 1 February 2021, what happened there? Let's go and see. I believe that I made a progress payment, and then I also made a progress payment in July, September, and March. And there I have gone and indicated it February, July, I think September, and March. So I indicated these progress payment dates on my timeline. Then on 1 April, that was the date on which I got the debentures issued. And then I believe the other date would refer to the general loan date. Let's just check it at the beginning of the question on 1 February. So there I've indicated, there I have indicated the, where's my paint now? There we go. There I have indicated the dates for the, I think it was 1 February. Yes, 1 February. There I have indicated the date for it. So the date on which you get funding, the date on which you make progress payments, and the date of year end. So there's my 31st December 2021 year end, 31st December 2022 year end. All right. So this is what I indicate on my timeline. And then I use the intervals between the dates like this. I use as my date interval on my block, right? So you would observe that I said on my answer 1 January to 1 February. So there it is. 1 January to 1 February. Then February to April. Then April to July. April to July. July to September. September to December. So this is where I got these date intervals from. When you fill out your calculations, okay, so going forward and filling out the rest of the information, when you fill out your calculations, you're going to start by saying the opening expense in the very first entry that you make for this calculation will always be 0. So for between January and February, no progress payments were yet made. So everything in that interval would have been 0 because we have an opening expense of 0. There's no progress payments between 1 January and basically the last day of January. And then the expense is nothing because the opening plus the expense becomes the total expense. And because the total expense is 0, the closing expense will also be 0. And then this closing becomes the opening. Now, between 1 February and 1 April, we have a progress payment of 1 million rand. And the progress payments are filled out in the interval which starts with the date of the progress payment. So if I look at the progress payment, it was made on 1 February, and the date interval that starts with 1 February is the second one. So that's why I go and fill out my 1 million here. Then 0 plus 1 million gives us 1 million. And now I'm going to say I am still in the timing before I have a change of rate. Because if I look at my rates that I've calculated, from 1 January until the 31st of March / the 1st of April, we don't account for one day, it should be 12%. But then on 1 April, we get new funding and the rate changes to 14.37%. So you should just mind that. So we're going to say between 1 February, 31st of March / 1 April, there's a progress payment of 1 million. So we take the 0 plus 1 million gives us 1 million. 1 million times the 12%, and then it's 2 months because it's February, March. I don't count April because it's the 1st of April. And that gives us 20,000 Rand. And the closing expense is equal to the total expense. The closing expense becomes the opening expense. And here we don't have any progress payments. However, this is an important interval. We should indicate the date of funding because on the date of funding, the interest rate, the average interest rate changes. So now we still have a 1 million because there was no progress payment, and 1 million plus nothing is 1 million. However, now we're going to use the rate 14 at 0,1437, which is the average rate that we've calculated after the debentures were received. And this is for 3 months, April, May, and June. I'm not going to count July because it's the 1st of July. And you get to 35,925. Still, the closing expense is equal to the total expense, 1 million. Then the next interval is 1 July to 1 September. And here we have an opening of 1 million and a payment on the 1st of July of 2 million. And the sum of those two is 3 million. Then we use the 3 million times the average rate times 2 months. July and August. September is not counted because it's the 1st of September. And that gives us 71,850. Closing balance, 3 million. It becomes opening balance. Then we do our calculation 1 September to, it should be our year end, 31st of December. And for the 31st of December, we have 6 million because on 1 September, we make a 3 million payment. So the opening plus the 3 million gives us 6 million. And then it is 6 million times 14,37 times 4 months. September, October, November, and December. 4 months, and you get 287,400. So at this point, I'm adding together the 20,000, the 35,000, the 71,800, 850, and the 278, and this gives us a total of 415,175 and a closing expense of 6 million. All right, then we have to go and calculate our actual interest. So this is the interest that you have always calculated, as I said, since you were at school. So for the bank overdraft, we're going to say it's 1 million times 12%, and we've had it for the whole year. So that's 120,000. And it is 5 million times 15%. So this is the debentures times the debenture rate. And that one existed for 9 months of the year, which gives us 562,500. If we add the 120 to the 562,500, we get a 682,500 total actual interest. So the actual interest is just what really happened in the real world with the actual interest rates given of that loan or that type of general funding. Let's look at the journal entries that we will post. So for the journal entries, we're going to start with the 1st of February. And that was when we've made the first payment to our first progress payment. You will find that for bank overdrafts, we do not account for a bank overdraft. So on 1 January, we're not going to say we get a bank overdraft, right? Because a bank overdraft just means you already have a bank account and you can just withdraw more money from that bank account than you have in that account. So you can go lesser than 0. So here I've said you debit the intangible asset because this is the first progress payment. So progress payment is for the construction of an intangible asset. They didn't tell us what type of intangible asset it is. So I just called it intangible asset, but it can be a website, a copyright, a license, we don't know. And then I credited the bank overdraft. They did not per se tell us that the bank is already in overdraft, but so potentially you could also credit just the bank account, right? And then when you do your statements, the bank will just be listed as a liability or more specifically a current liability. So this is the first progress payment that we've paid. Then on the 1st of April, and you can actually also use your timeline to see what you need to account for. So on 1 January, we're not going to account for the bank overdraft because bank overdraft isn't something that you account for. You just spend money out of your bank, right? But on the 1st of February, that's a progress payment and we account for it. Then we have to, on 1 April, we need to account for something. What would that be? That was when we issued the debentures and we got some money. So then we have to again account for 1 July and 1 September. So you can actually use this timeline also to guide you through the journals that need to be done, but do mind the bank overdraft. Sometimes students are caught out with that. Right, so on the 1st of April, we issue debentures, so we get money in our bank account, and then we put that money towards a loan account called debentures, and we have issued debentures worth 5 million rand. Then on 1 July, we make another progress payment. So it is intangible asset and bank, intangible asset and bank. Again, at this point, we are not sure whether the bank is still in overdraft or what is happening because they don't give you a bank total to begin with. So I have said bank, but it would have also been correct even if you said bank overdraft. But did this take us out of overdraft? Well, probably, you can argue about it. Then on the 1st of September, there was another progress payment. We debit the historical cost of the asset that we are constructing, and we put it against the bank account. Then on the 31st of December, this is our financial year end, and now we have to go and account for all our interest. So the trick here is that some of the interest will now be capitalized, which means that we add it to the cost price or the historical cost of the asset that we are constructing, aka your qualifying asset. And then some of it will be finance cost expense. And a finance cost expense is what we typically call our profit and loss portion, right? So profit and loss portion will be the finance cost of the interest expense that is listed in your statement of profit or loss and other comprehensive income. Just before you get taxation, right, you get profit before finance charges, then you get finance charges. That finance charges will be an amount, this amount listed there. Then from the bank account, we pay our actual interest as per step 3. So from the bank account, that would be what happened in real life. This is step 3. Then for the intangible asset, we need to go back to our average interest calculation. And the sum of the average interest that falls within this capitalization period will be taken to the historical cost of the asset that is constructed, and then the profit and loss portion is the difference between step 3 and step 2. So this is basically a balancing figure that is taken to your interest cost or your interest expense or your finance cost, whatever you would like to call it. So these are the general journal entries that need to be done, and as I said, the timeline is quite a good indication of what we need to go and what dates we need to go and do calculations and journals for. Right, now we're in the next year, which is the year ended 31st December 2022. And what is very important is that we need to calculate an average interest for every year, right? So you cannot calculate an average rate for the first year and then continue to work with that average rate throughout, because the average rates will change when you start a new financial year. So the beginning of a new financial year means that you need to calculate a new average rate. Right, let's see what happens here. We are on step 1 for the year ended 31st December 2022. Now we're going to take the bank overdraft and the debentures, but we already had this funding in the previous year. So to get to the loan proportional to months, it's going to be 1 million times 12 out of 12. And also the debentures will be 5 million times 12 out of 12 because we've had it since April of the previous year. So for this year, it will exist for the entire year. We get to the sum of our proportional loans, 6 million, and then we use it as a weighing to calculate our average rate. For bank overdraft, it's going to be 1 million divided by 6 million times 12%. And for the debentures, it's going to be 5 million out of 6 million times 15. And the average rates added together gives us 14.5. There's also a change later in this calculation because we obtain another type of funding. If we look at the original question, we obtain a general loan on 1 February 2022. And each time you get new funding, the average rate should also change. So the average rate will just change at the beginning of the year when a new year starts, because you will no longer have the effect where, for example, here, you had to adjust the debentures 9 out of 12, but now in the new year, the debentures will be 12 out of 12. So automatically, the rate just changes when a new year starts. But then it will change again when new funding is obtained in the new year. So at this point, we have three types of loans. So as from the 1st of February, we have a different rate. So for January to February, we have one type of calculation to do at 14.5%, but then as from the 1st of February, the rate changes again. And now we're still going to say we have a bank overdraft and debentures at 12 out of 12 months, but now we also have a general loan, and the general loan is received on the 1st of February. So if we count the months proportionally to what remains in the year, it is going to be February, March, April, May, June, July, August, September, October, November, and December, which is 11 months. So yeah, I've taken the 1.5 million and I've adjusted it for 11 out of 12 months, and that gave us 1375000. Then we have to add together 1 million and the 1 million and the 5 million, and we get of 7375000, and the 1 million, the 5 million, and the 1375 gives us the 7375000. Now we need to go and calculate a new average rate. So it's going to be 1 million out of this total times 12%, 5 million divided by this total times 15%, and then the 1375 divided by this total times 14%. And if we add all the averages together, you get 14.41%. So that would be your step one, done twice, once at the beginning of the year and once again when new funding is obtained. Right, let's look at step two. What happens now for step two? For step two, we're going to say our first interval is 1 January to 1 February. So basically 31st of December or 1 January. We don't account for one day. 1 January to 1 February. So I've just jotted my date intervals. Something that is important to remember is the capitalization period ending. The capitalization period ends 31st of March, so we need to stop the capitalization on that date. So I'm going to start by carrying over my 6 million, and the 6 million came from this closing expense. So this closing expense becomes the opening expense. So it's carried over. There's no progress payment, and the average rate between January and February was the 14.5% that we calculated at the beginning of the year, and that gives us 72,500. Our total expense is the closing expense. Closing expense becomes the opening expense. In the next interval, there is no progress payment made, but the rate changes because on the 1st of February, we got the general loan. So now the rate changes to 14.41. So we take the 6 million times 14.41 for 1 month, and that gives us 72,050. And then we have the 6 million still. It becomes our closing expense. Again, we have then a progress payment. The total opening expense plus the progress payment, 7.5 million, and we still use the average rate of 14.41 for 1 month, and that gives us 90,062.50 cents. At this point, I'm going to stop, and I highlighted this in yellow, said not in capitalization period. So 31st of March to 31st of December, I'm not going to do calculations because that falls without the capitalization period, and because it's not included, we don't have to calculate it. And for this reason, we will just add up all these totals, and I get to 234,612.50 cents. Step 3 says I also have to calculate my actual interest. So now I have, for the whole year, bank overdraft at 12%. For the whole year, a 5 million rand debenture loan for 15%. And then I have a general loan at 14% for 11 months. And if I add all the actual interest together, I get a 106,500 actual interest for the year ended 31st December 2022. Let's explore the journal entries that we would do, right? So the first one is the 1st of February, so that would be the first interval there that we need to account for. So on the 1st of February, we obtain a general loan, 1.5 million in the bank account. Then on 1 March, we make a payment to the construction company, a progress payment, and we put it against the historical cost of the asset. On 31st December, we have a year end. And now again, we need to go and account for the actual interest, the capitalized interest, and also the balancing figure, which goes to profit and loss. So to the historical cost price of the intangible asset, we book our total that we've calculated for average interest. Our step 3 goes to out of the bank account, because what really happens is always reflected in the bank account. And then the balancing figure goes to profit and loss, which is typically your finance cost, your interest expense, your pure profit and loss that is listed in your statement of profit and loss, and other comprehensive income. What is also important is to remember that we have now an asset that is in use, right? So they tell us the asset is ready for use on the 31st of March 2022. So at this point, the capitalization period stops and the asset can be used. We have to go and calculate a cost price for this intangible asset, and we do not write off against the intangible asset. We do not write off depreciation, but IAS 38 calls it amortization rather. Right, so we debit the amortization, we credit accumulated amortization in tangible assets. In order to get to the cost price, we're going to add together all the progress payments that were made to construct this asset. So it's the sum of all these payments. Let me just take you back. The sum of all these payments. Right. And then we have capitalized some interest. So in the current year, we've capitalized the 234,612.50. In the previous year, 2021, we capitalized 415,175. So you would find that amount right there. So it's this entry that we did there. If you put interest against the historical cost because it fell within the capitalization period, that interest amount should be added to the cost price of the asset. Then I've added it all together to get to the cost price, times it by 20%, and we were able to use this asset from April, May, June, July, August, September, October, November, December for 9 months. So if I calculate amortization at 20% for 9 months, I get 1,222,468 cents. Right, there might be an instance where they also tell you in a question that the entity will invest excess money in a savings account, right? So that means we normally sit with some loan money, right? And then we have to make a progress payment, but only later. So the bank or the financial institution has already given us the money, but the money in terms of our contract with the contractor is not yet due to the contractor. So now I don't want to sit with 5 or 6 or 10 million rand on hand and not have it work for me. And what people normally do is they put it in an investment account where they can get a bit of interest. So it's basically a savings account, and then they earn interest on the money that has not yet been paid to the contractor. So let's explore that. How do we calculate our interest earned? So for interest earned, you still need your timeline that you've drawn up. But now I prescribe that you just use your layout a bit different. And you still have a date interval, right? Then you have a loan amount in that you receive into that savings account. You have a progress payment. In this instance, your progress payment will be minused from the inflow of the loan, and you get a total, and the total is used to calculate interest, but at the rate given. So now you don't use an average rate or some kind of rate that you have calculated. You just use the 3%, the 2%, the 5%, the 10% that has been given, that is associated with your savings account. Right. If we go back to our timeline, it tells us that we have, for January, we get a bank overdraft. Then on 1 February, there's a first progress payment made. And then on 1 April, we get our debenture money, right? So what I've put on this calculation is that you should please remember that on a bank overdraft, you cannot earn interest. So bank overdraft means that you have the right to withdraw more money out of your account than you actually have in that account. But It does not mean that you can't take a bank overdraft and invest it somewhere, right? Like a bank overdraft is just a perk because you have a certain account, but you can't withdraw a bank overdraft. You can't go and put it somewhere else in another account. So this is important, because if we look at the question, the bank overdraft was worth 1 million rand, and then the first payment, just want to go back to the original slides. The first payment was 1 million rand. So we had a bank overdraft of 1 million rand, and then the first payment was made with that bank overdraft, and then we needed more money. So here on the 1st of April, we obtained the debenture money. And as you can see, my calculation that I've done for interest earned, the investment account can only start on 1 April, because only on 1 April we have actual money that we receive from the debentures that we can go and invest. All right. So on 1 April to 1 July, which is my interval 1 April to 1 July on my timeline, we have 5 million, which is the inflow of the debentures. And within this time frame, we do not make a progress payment. So it is April, May, and June. For 3 months, we get 3% interest. On the 1st of July, there is a progress payment that is made. And please remember, when the progress payment is made, we indicate it with the interval where the date starts with the date on which the progress payment is made. So 1 July, we make a 2 million rand payment. So there's no new loan interval, but you can also carry over the 5 million if you want to use it as effectively as an opening balance as well. But all that I've done here is to say 5 million, which is in the savings account, minus 2 million leaves us with 3 million. And with 3 million in the savings account for July, August, only 2 months, September, I don't count because it's the 1st. Then on the 1st of September, we make a progress payment of 3 million. Now it's 3 million minus 3 million, and there's nothing in that account, and we can't earn any interest in that interval of time. So I've only added together the two types of, or the two intervals of interest that I've earned, which is 50 to 500. All right, so how will your journals now look differently if you have a savings account? So the difference will lie in the use of a savings account rather than the bank account. So for the intangible asset, on the 1st of April, that 1 million rand that you have paid out of the bank overdraft, that will stay the same, right? Because that is the progress payment out of the bank overdraft. But you will find that now when we make progress payments, the progress payments are not made out of the bank, they are made out of a savings account. With the 1st of July, it's made out of the savings account. On the 1st of September, the progress payment is made out of the savings account. Then our calculation for the interest will remain the same. The step 3 will go to your bank. The intangible assets will be the total that you've calculated for your interest expense or your average interest expense. And then the finance cost will be the balancing figure. What happens now is that you should remember that the interest that you've earned in the capitalization period will now have the opposite effect of the interest that you have incurred, or the interest cost. So because you were able to earn 52,500, it's going to make the assets historical cost lesser by 52,500. So all interest income that is earned that falls within the capitalization period will not be booked as your interest income, but it will be booked as the intangible asset or a credit against the cost price of the intangible asset. So that's just something important to remember. And then, of course, the interest is paid into that savings account, because if you have a savings account, for example, with Capitec, and you get a bit of interest, they put the interest back into the account that you have with them. So that is just the difference in the journals that you would have to book when there is a portion in the question that says you also earn interest. How about if we have an instance where interest is not paid for as incurred? All right, so at the beginning, I underlined in the question the sentence, and I said it was very important. Interest payments are done as the interest is incurred. So we pay for, as soon as we owe the interest, we pay the interest, right? That's why by year end, we account for all the interest that we should have paid, right? But now what happens if a question should tell you that we don't pay the interest? The capital and the interest is paid at some date in the future, because we normally do these calculations based on the assumption that the interest is paid now and that the capital is paid later. But what if the interest and the capital is paid later? How will this change your calculation? Well, it will have an effect on the step 2 that you need to do. And the effect will look as follows, right? You are going to have still an opening expense of nothing, your 1 million rand progress payment, a total expense of 1 million. And then you still calculate your interest at the average interest rate for the months in this time interval. But now your closing expense, the way that you calculate your closing expense will differ. Because now you're going to say it's the total expense plus the interest is the closing expense. Now we don't ignore the interest. We add it to the closing expense because we have to eventually go and pay the interest. We're not paying it now. Then the closing becomes the opening. There's no progress payment. It's 1,020,000. We have a change in interest rate. And now we base it on the 1,020,000 rand at the average rate for the 3 months in the interval. And now we add together this 1,020,000 with the 36,643.50 to get to this closing expense. The closing becomes the opening. There's a progress payment of 2 million. We add these figures together to get to the 3056. That amount is used at the average rate for the months in the interval to give us the 736,206, I beg your pardon. And then this total expense plus the 73206 is used to get to this 3129,850 and 11 cents. It becomes our opening expense. We add the progress payment. Now we have 6,129,850 rand and 11 cents. The amount is used to calculate our interest at the average rate for the months in the interval. And then again, the 6 million plus the 293,619 is used to get to the closing expense. Now the sum of my average interest is changed. So now if you add together the 20, the 36, the 73, the 293, you get 423,469.93. The journal entries will now look as follows, assuming that you also have earned interest income. This journal that you book will be now, you will still have your actual interest. So the actual interest, what really happened in the real world, is not going to change. But this intangible asset portion that you go and capitalize will change to the amount that you have added up there. And then obviously because of this change, the balancing figure, which is your finance cost or your profit and loss interest expense, will also change to a different figure so that the whole journal in itself balances out. So I just wanted to bring that under your attention. If the interest is not paid, we have to carry it in the closing balance. And it's important to remember because the average interest will be affected by it. All right, so the rest of the slides I am going to cover in the next lecture on general loans. I hope that you have enjoyed this explanation, and I will then see you in the next part where I explain the general loan that is evenly incurred. Keep well until you watch the next part.